Today, pedal harder for less returns. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today I want to discuss the results from the banks in Australia as they report their latest numbers. Essentially, the story is one of loan growth in terms of volume, especially mortgages, compression in terms of profitability thanks to margin compression, with loan discounting to attract new business, offsetting only minor improvements in deposit rates. And the results are also very noisy thanks to one-off adjustments and the release of provisions. Take Suncorp as an example. The bank saw its net margin slide in the 6 months to December, despite gaining $1.2 billion in new home loans and a steady rise in broker originations. Suncorp posted its results for the first half of 2022 on the 8th of February, revealing a 20.8% decline in group net profit to $388 million off the back of a surge in insurance claim costs from 19 extreme weather events. The banking business, however, delivered a $200 million profit, up 5% from the previous corresponding period. The home loan book rose by $1.2 billion, or up 5.3% during the half, to a total of $47.3 billion. A year prior, home loans fell by $769 million, down 3.3% in the first half of financial year 21. Suncorp reported that it's now approached APRA system growth rates toward the end of the last half, although it remains slightly below that benchmark. Despite the growth in home loans, net interest income was somewhat flat, up by just 0.5% to $621 million, and the bank's net interest margin, or NIM, has declined to 197 basis points, down from 209 basis points in the second half of financial year 21 and 204 basis points in the first half. Net interest margin gives you the difference between the costs of funds and the value generated when those funds are lent out. Jeremy Robson, Chief Group Financial Officer at Suncorp, said competitive pressures, movements in market rates, a higher fixed-rate lending mix and additional liquidity has squeezed the bank's NIM. The net interest margin of 197 basis points remains above our target of 185 to 195, and now we expect it to trend back to within the range in the near future, slightly earlier than previously expected, given interest funding and price dynamics, Mr. Robson said during an analyst briefing. Suncorp Chief Executive Steve Johnson added that the expected NIM range remains a relevant reference point for how the executive team sees the management of the bank and its loan book. We've been at 287 and 209, and you know that it's an aberration in a sense, given some of the tailwinds on the funding side of the book that were never going to be sustainable, he said. As we report here, we're above the top of our range. We expect to be back in our range pretty soon. Clive Van Horen, CEO of Banking and Wealth, echoed his colleagues, as well as recent updates from ANZ and Westpac, stating margin pressures widely across the industry are pretty significant. And the report from Suncorp also cited increased portfolio outflows driven by higher customer repayments, external refinancing and property sales, which were up by 17% during the half. All the while, the bank noted that it had achieved a positive net refinance rate each month during the half, as more customers had switched to Suncorp than those opting for competitors. Home loan settlements rose by 40% from the second half of financial year 21 and 70% year on year to $7.2 billion worth. Broker originations had also risen, with the channel accounting for 75% of new loans during the half. During the previous 6 months, brokers had written 69% of the bank's home loan originations, after they accounted for 65% of new loans. Of the overall Suncorp home loan book, brokers are now the source for 69%, which is fairly consistent from the previous year's proportion of 68%. The Queensland-centred bank has also indicated ambitions to extend its reach across other states, having targeted brokers with New South Wales and Victorian customers with the expansion of its business development management team. Suncorp has invested in its mortgage processes, targeting more efficient origination and improved broker and customer experience, But despite the uptick in volumes, median turnarounds in home loan applications slimmed down to 14 days from 16 days in the previous half. As Mr. Johnson put it to analysts, the bank's ultimate objective is to consistently match best in market for home loan origination, as well as vying for more market share and positive growth. And meantime, CBA's first half 22 cash earnings on the company basis from continued operations was $4.7 billion, ahead of expectations and up 22.7% on the prior comparable period. But this was entirely driven by a large beat on other non-interest income, reflecting the AIA milestone payment and higher treasury income in the half. Also, lower expenses and a write-down in bad and doubtful debts, which was all partially offset by lower net interest margins. All the banks are wrestling with this compression as funding costs rise and competition for mortgage business intensifies. In CBA's case, margin declined 17 basis points, driven by lower fixed spreads down 2 basis points, the housing mix down 4 basis points, and price competition down 3 basis points. But there was an offset from deposit repricing and deposit mix of up 3 basis points. In other words, they don't hand as much back to depositors. On the outlook, CBA said that margins will remain under pressure until we see a rising cash rate environment, with the second half 22 net interest margin callouts mostly negative. Given CBA's strong capital position, though, CBA now intends to undertake a further capital management via an on-market buyback of up to $2 billion. The buyback is expected to reduce the CET1 ratio by around 42 basis points. Post the buyback, CBA will remain, though, well placed to accommodate changes under APRA's new capital framework, which is going to come in from 1 January 23. But on the net interest margin outlook, headwinds are expected to include the impact of higher swap rates on fixed home loans, the fixed home loan mix, the impact of price competition on the standard variable rate home loans, plus higher wholesale rates. And of course, there's also the question of the unwinding of the term funding facility, that very cheap money from the RBA. Over the medium term, though, they say net interest margin is expected to benefit from a higher cash rate, higher swap rates coming through equity deposit hedge portfolios, and the normalisation of housing flow. So you can see here that most of the banks are having to run harder to lend more money, particularly for home lending, but at a narrower margin. And of course, the net result of that is profit pressure. As a result of that, my expectation is that we're going to see some significant mortgage price rises ahead, even if the RBA leaves the cash rate where it is. And of course, the market expectation is now for considerable rises in the RBA cash rate this year. It'll be interesting to see whether the market is right or whether the RBA holds firm. But out-of-cycle price rises for mortgages seems to me to be absolutely on the cards. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.